Banks should be encouraged to explore new technology, to engage in discussions with their regulators about how they can be deployed, and what reasonable supervisory expectations should apply. Innovators, banks, and regulators must develop a constructive relationship, and this relies on a commitment to ongoing outreach. Beginning of what appears to be a seismic shift in the way we think about money, value, and the fabric of our financial system. This shift is not just about incremental changes or tweaks to the existing system. What we're witnessing has the potential to fundamentally transform the way we live, the way we work, and the way we interact in society. It's inspiring to be together with all of you as thought leaders who are engaged in developing technologies that could help shape the financial system well into the future. You don't need a tech background to appreciate the opportunity that blockchain provides to the financial system. Financial services innovation drives faster, safer, cheaper, and more customized products that more efficiently meet the needs of consumers and businesses. Digital processes like wire transfers and ACH disrupted the need to move large amounts of physical currency and other hard assets, making the system more efficient and safer. Through technology, there is opportunity to transform how we think about transferring assets. Throughout recent history, whether previous transformations involved industrialization, communications, or the internet, each of these advances had a profound and lasting impact on our society. While the future is unknown and unknowable, I expect that we may look back at some point to consider the impact of blockchain, of AI, and quantum computing, and marvel at the transformation in everyday business processes. Time will tell, but the opportunities and possibilities that lie ahead may be profound. Of course, you know better than most that bank regulators approach technology and periods of change with caution and skepticism, concerned about rapid growth, new business models, greater interconnectedness and interdependence, and we often focus only on the risks. But risks may be offset, or at least determined to be manageable, when we recognize and consider the potentially extensive benefits of new technology. Today, I'd like to address the Federal Reserve's approach to thinking about technology and tools like blockchain in the context of supervision, including recent developments in the cost of supervisory focus on reputational risk and principles for a tailored and permissive regulatory framework, one that accommodates technology. So I want to start by talking about reframing our regulatory mindset. Bank regulators work to promote safety and soundness in the financial system through regulation and supervisory practices. Our goal is not just a safe and sound banking system, but one that also serves its intended purpose of supporting consumers, businesses, and communities, and fostering economic growth. To accomplish this goal, regulators strive to strike a balance between managing risks that threaten safety and soundness, while also creating an environment that allows new technologies to take root and grow. Innovation outside the banking system often complements the development and use of technology within the banking system, and it often far outpaces that growth. As you all are well aware, many groundbreaking tech innovations have been pioneered by developers outside of the traditional banking system. But we are seeing a number of promising developments inside the banking and financial system, and I'll start with tokenization. While progress on tokenization is moving ahead, it's helpful to identify and understand the problem that it's intended to solve. One clear friction is in the transfer of asset ownership, which includes both completing the asset transfer, which may involve re-registering securities, or transferring physical assets and coordinating the timing of the purchase and sale. Asset transfer frameworks are designed to minimize the risk of transaction failures, and they have historically relied on escrow agents and manual processes. Tokenization has the potential to facilitate faster ownership transfers, mitigating some of these well-known risks and potentially lowering costs in the process. But tokenized assets enable a transferor to pass title without changing a custodian or moving any physical security or asset. Many banks and international organizations have begun projects to develop this technology, but we have not yet seen broad adoption. It's possible that we could see a tipping point where the processes themselves are well established and legal frameworks have been updated to permit a wider range of activities relying on that new technology, and tokenized asset transfers become more of a market standard. There are other potential advantages to tokenization, including expanding access to capital markets and facilitating near real-time payments. The speed and cost of wholesale payments, especially internationally, is a long-standing problem that tokenization could help to address. Banks of all sizes, including community banks, can benefit from efficiency gains that flow from asset tokenization. New technology and processes can open the door to direct, faster, and lower cost payments. While tokenization may be a part of the solution to a number of known frictions in the banking system, the blockchain technology that it relies upon has already changed how banks seek to engage with their customers. For example, while digital assets have been considered to be risky, many banks are improving their tech stacks and security infrastructure to provide digital asset custody services to a wider range of retail customers. Very few bankers and even fewer regulators anticipated that the market would accommodate this development even just a few short years ago. Yet we've seen much progress and a growing appetite for traditional bank engagement in this space. We're also seeing positive signs in the evolution of the digital asset user experience, making it more accessible and easier to use. One recent development, Congress passing the Genius Act and the President signing it into law, has brought stablecoins to the forefront of many discussions. And they're now positioned to become a fixture in the financial system, with implications and opportunities for the traditional banking system, including the potential to disrupt traditional payment rails. Congress has tasked the banking agencies with creating a regulatory framework for stablecoins, and we're working with our colleagues in the other agencies to move this forward. It's essential that banks and regulators are open to engaging in new technologies and departing from the overly cautious mindset. Regulators must understand new products and services and recognize the utility and necessity of embracing technology in the traditional financial sector. So how do we accomplish this? Some of you may have had direct experience with regulators in the banking system as you attempted to engage in this type of partnership with banks through the introduction of new technology and services. I'm sure that many of you were not satisfied with those interactions. When you start, is that an understatement? When you start from a world of possibility, where you move fast and you break things to make rapid improvements, you may struggle with that complex and rigid regulatory construct that's familiar to bankers and regulators. In this world, inertia can easily set in and pose resistance to anything not deemed within the realm of traditional banking services and activities. But despite this past inertia, change is coming. Bank regulators are taking important steps to create a framework for digital assets and the adoption of blockchain technology within the banking system. These steps will promote accessibility to banking products and services by removing supervisory impediments that have stood in the way of bank relationships. I'm also encouraged by the promise of this technology, by its ability to solve problems and improve efficiency of the traditional financial system. So up to this point today, I've noted several use cases that have already been adopted or are in development in the banking system. But I'd like to encourage industry to engage with regulators to help us understand blockchain and its potential to solve other problems. What's the value proposition of any new product or approach? What problem is it intended to address? And how should regulators consider both the risks and the benefits so that we can provide a path to allow its use within the banking system? We've already seen some initial benefits of bank AI adoption, and I continue to be encouraged by these significant ongoing investments being made in AI and in machine learning. These technologies have the potential to transform how business is conducted, including the way we prevent and detect fraud, manage risk, and provide customer service. During a recent banking conference at the Fed, Sam Altman, the CEO of OpenAI, joined me for a fireside chat on AI in the banking and financial sector. One highlight from our discussion was the two-sided nature of how technology can impact banking transactions. Just as AI can undermine customer verification methods designed to identify and mitigate fraud, AI tools can be leveraged to detect and mitigate fraud. And I see similar challenge with blockchain technologies. Some bankers have expressed concerns about new technologies posing a threat to traditional business models and practices. But the banking system is constantly evolving, and technology can change the banking system regardless of how banks and regulators choose to respond. We must choose whether to embrace change and help shape a framework that will be reliable and durable, ensuring the safety and soundness and incorporating the benefits of both efficiency and speed. Or we can choose to stand still and allow new technology to bypass the traditional banking system altogether. The choice from a regulator's perspective is clear. I am open to these discussions, and I look forward to learning more. Many of you at this conference today have a great deal to share and have new ideas about the best regulatory approaches to blockchain and digital assets. So let me start with a specific request on fraud. How can new technologies be leveraged to fight fraud? It's a major challenge in the financial services sector, and if blockchain or other new tools can help to mitigate it, we should explore those use cases. If fraud can be addressed using new technology, we should make sure that the regulatory framework does not stand in the way. I see this as an exciting opportunity for collaboration between industry and the Fed. The promise of technology and advances like AI are already positioned to impact parts of the banking and financial system. And ideally, changes will occur with the willing embrace of regulators, allowing use cases to proliferate in a way that benefits the banking system. If this is not our approach, then we risk the banking system becoming less relevant to consumers, businesses, and the overall economy. As a result, the banks will play a diminished role in the financial system more broadly. And those who follow developments in bank regulation have hopefully recognized a number of positive steps that demonstrate our commitment to embrace change. I am committed to changing our culture at the Federal Reserve and our attitude toward the adoption and integration of technology and new products and services. So I want to turn now to talk about debanking and reputational risk. In late June, the board announced that reputational risk would no longer be considered in our supervisory processes. To implement this lasting change, we are updating our guidance, our examination manuals, our handbooks, and other supervisory materials to ensure the durability of this approach, which is a critical step in addressing the problem of debanking. I'm also considering whether we need a regulatory change to provide greater transparency and certainty about this approach. It's not the role of examiners or policymakers to direct which customers or industries to serve or which products to offer. That decision lies solely within the purview of bank management, limited only by the safety and soundness of the institution, the legal activities of its customer, and risks, if any, to financial stability. Over time, reputational risk emerged as a priority area that policymakers emphasized for examinations. Exams or reviews focused on reputational risk have often lacked a sufficient nexus to financial risk and safety and soundness considerations that are the appropriate focus for our supervisory activities. So let me be clear. We must adopt an approach that does not penalize or prohibit a bank from banking a customer that's engaged in legal activity. This approach must allow and encourage banks to provide banking products and services to any legal business without disfavoring any particular viewpoints, businesses, or industries. So I'm going to turn now to talk about the approach that I've adopted since becoming a regulator at the state level, which is the importance of outreach. The industry, whether it's traditional finance, community banking, or digital assets, should expect a constructive engagement with our supervisors when they're discussing strategies or approaches for innovation. As regulators, we must engage in a way that enables our supervisory teams to understand the technology or innovation that's under consideration and have an open-minded view about the benefits and the possibilities of a new approach, while also understanding effective mitigation strategies that could address any risks. Banks should be encouraged to explore new technology, to engage in discussions with their regulators about how they can be deployed, and what reasonable supervisory expectations should apply. In this context, a healthy dialogue and a commitment to learning ensures the bank and examiner relationship can be collaborative rather than agnostic in tone or antagonistic in tone. Innovators, banks, and regulators must develop a constructive relationship, and this relies on a commitment to ongoing outreach. As I've demonstrated throughout my tenure as a regulator at both the state and the federal levels, I'm committed to outreach that enhances my understanding of industry preferences, challenges, and better ways to engage with both developers and adopters. We should build an examination workforce that requires skills development and informed judgment to address evolving business preferences, practices, and expectations. And in a step toward doing so, last week I announced that the Novel Banking Activities Supervision Group would be reintegrated within our Reserve Bank examination staff, reestablishing the normal practice of our bank examinations. Our approach should consider allowing Federal Reserve staff to hold de minimis amounts of crypto and other types of digital assets so that they can achieve a working understanding of the underlying functionality. While there are many resources available to learn about these financial products, and we will soon be establishing a framework for supervising issuers of these assets, there's really no replacement for experimenting and understanding how ownership and the transfer process flows. I certainly wouldn't trust anyone to teach me to ski if they've never put on skis, regardless of how many books or articles they've read or even wrote about it. So we should consider whether limits on staff investment activities may be a barrier to recruiting and retaining staff with necessary expertise, and for existing staff to better understand the technology. Going forward, it will be necessary to continue to implement a tailored approach to these new technologies in our supervisory activities. An approach that balances the supervisory and regulatory expectations in a way that is commensurate with the risk. What would this look like in practice? It needs to include regulatory certainty, tailoring, consumer protection, and maintaining America's reputation for providing an open environment for innovation. Regulators should abide by these principles in developing this framework. The first principle is essential, and that's regulatory certainty. Justifying investing in new blockchain development specifically for the banking industry, or even repurposing existing blockchain technologies for this sector, requires significant investment. Why would you make that investment without a clear understanding about how regulators will evaluate new use cases in the highly regulated industry of banking? Would you choose to partner with banks knowing that this will bring regulatory scrutiny and uncertainty, or would you develop alternatives outside of the banking system? Your industry has already experienced significant frictions with bank regulators, applying unclear standards, conflicting guidance, and inconsistent regulatory interpretations. We need a clear, strategic regulatory framework that will facilitate the adoption of new technology, recognizing that in some cases, it may be inadequate or inappropriate to apply existing regulatory guidance to address emerging tech. Having clear and transparent rules is not effective if the rules are unnecessarily burdensome and restrictive. So my second principle is that rules must be well calibrated and tailored to address the risks. Well-calibrated regulation promotes responsible innovation while also aligning incentives for long-term growth and stability. Tailoring rules and supervision requires regulators to approach each use case based on particular facts and circumstances, rather than applying expectations designed for an imaginary worst-case scenario that differs from the actual use case. We can't adopt a one-size-fits-all approach. And regulators must recognize the unique features of these new assets and distinguish them from traditional financial instruments or banking products. A third principle is that frameworks must be consistent with generally applicable rules and requirements. Customer-facing products must comply with consumer protection laws, including those prohibiting unfair, deceptive, or abusive acts and practices. We must think carefully about appropriate regulations to protect consumers and investors, maintain bank safety and soundness, and preserve the stability of the financial system. Any legal framework must also include appropriate Bank Secrecy Act and anti-money laundering requirements to fulfill the important policy objectives of these requirements. Finally, we need to build a framework that allows the US to continue to be the best place in the world to innovate. Failing to do so could jeopardize American competitiveness in the long run. Regulators have taken preliminary steps to support blockchain technology within the banking system, as well as to eliminate deterrence for banks to provide services to the digital asset industry. And I'm confident that with the benefit of ongoing outreach and education, we will build a framework that is fair, efficient, and transparent. So in closing, I just want to note that we stand at a crossroads. We can either seize the opportunity to shape the future, or we can risk being left behind. By embracing innovation with a principled approach, we can define the course of history and fulfill our responsibility to promote the safety and soundness of the banking system and financial stability. We are mindful of the potential risks and vulnerabilities that result from rapid transformation. We're cautious about the unintended consequences, and our mindset and policies guide us toward minimizing risks. But we must pay equal attention to the benefits side of the equation. Innovation and regulation don't need to be on opposite sides of the spectrum. In fact, they can complement each other. A more modern, efficient, and effective financial system furthers key regulatory objectives, promoting safe and sound banking operations, financial stability, and economic growth. Thank you very much.